And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. The S&P in breakout mode. Once again, up over 6% in the last 4 weeks, hitting historic highs. Several days in a row now, the market is rotating as we're seeing new highs in several key cyclical sectors like tech and industrials, for example. And by the way, it's not just the U.S. Surprisingly, we're seeing some breakouts on a more global scale as well. What do we make of all of this? Joining us now, Nick Colas. He's the co-founder of DataTrek, Steve Grasso, Stuart Frankel, and Deborah Fuhr, founder of ETFGI. The important thing here, Steve, is what amazes me about this is we're hitting new highs in cyclical sectors. Wait a minute, we're supposed to be in a global economic slowdown, and industrials are hitting new highs, tech's hitting new highs. Are we getting the rhythm of the global economy wrong? What's going on?
I think it's a matter of people are reaching for things that were supposed to be down, things that were, they've given up the ghost. And to me, it's either one of two things. It's always binary in an event. Is it that they're reaching for the last thing and it's the last gasp of the rally? Or is it just throwing in the towel and knowing that we're going higher overall? I'm gonna go for the latter. I'm long a lot of these chemical plays, paper plays, packaging plays. I don't think it's over just yet.
Yeah. Deborah, you follow fund flows. You're one of the great experts in the world on this subject. What's surprising me is it's okay to say, okay, the U.S. consumer is holding up, U.S. is all right, but Europe's hitting new highs. European ETFs, the Italian ETF, the French ETF, the German ETF, EFA, Europe, Africa, Far East, new highs today, and Japan as well hitting new highs today. Do you see any enthusiastic buying in terms of fund flows here, or is this just a sort of lack of people selling that's moving these to new highs? It's a bit surprising.
Well, I do think that people are preferring ETFs over other products, and so you are seeing more money going into ETFs than any other investment product right now. And I do think people are thinking there's still more upside, right? I think they've gotten used to some of this stuff just being out there as news, like Brexit. We're all kind of sick of it. I live in London, right? So I do think that investors see many markets still having more legs to go. And China's been doing well too, right? It's probably going to be the best performing market this year, where people thought China was really a problem this year. So I think people are taking a fresh look at where they should put money to work.
I think that was one of the main things that happened on Friday, Nick. I saw a little bit of a sea change. Volume picked up Friday on an up day. That hasn't happened in a long time. So we did see better economic data, as Deborah was pointing out, not just in the U.S., but Eurozone GDP was a little better than expected. The China manufacturing a little bit better. I don't know if this is sort of a turnaround, but if that keeps up, might that sort of change the earnings outlook for 2020? We're all thinking, well, maybe it's going to be flat to up 5% or something like that. Is that a factor now in this?
Yeah, it's a huge factor, because if you look at earnings year to date in the U.S., it was negative 0.4% comps Q1 and Q2. Looks about negative 2.5% in Q3. Q4 just went negative for analyst expectations. So clearly the market's not focused on that. They're thinking about that narrative you just outlined, which is if we get a trade deal, better economic growth, and it's global, then S&P, which is 38% international, is going to have maybe 5, 6, 7% earnings growth next year.
But parts of the market are already a little pricey. You know, industrials are up,
right.
tech's up. Banks are even been rallying as yields have been up a little bit. That leaves energy. I know you kind of like playing energy on this contrary play, but a lot of people have had their head handed.
Well, I would only play it for a bounce. There's a reason why the ETF is at is lower 5 years later in performance than any other ETF. I mean, it's still red on the screen. So how can you buy something that has not had the ability to perform in a 5-year economic cycle? That to me is atrocious. But if you want to buy it on a monthly, then buy it. Maybe you get that reversion trade, but not long term, no way.
Yeah. Dollar has stopped going up. Now that's got to be some help, Deborah, to European ETFs, to emerging market ETFs as well. I know you're not a macroeconomist, but that's obviously been a factor in helping emerging markets.
It definitely has. And I do think we've also seen that people have been using less currency hedge products. So they're looking for the play out of currencies locally. So I think we've seen people historically been using currency hedge ETFs. We've seen money move out of that and taking advantage of the differences in the dollar versus local currency. So definitely.
You know the problem though, Bob, is that when we talk about this and you look at Germany, and you started off the show saying what's really changed, and when you look at German PMIs, they were just at a decade low in September. So if you look at the mirror images from a lot of these ETFs from October 2018 to 2019 October, they're mirror images. They were down 10%, they're up 10 and 12%. This to me is people saying we got caught off guard. So I don't know how much is substance versus me just trading the market.
Yeah, and manufacturing, you mentioned PMI, is much more important in Germany than it is in the United States. What are we, 12% manufacturing in the United States? A much higher number in Germany. I just want to go back to you because you're not afraid to pontificate on the dollar. Why do you think the dollar has stopped going up and is now even actually off of its highs? Yeah, is that going to continue?
It ties directly to global yields. You saw global yields hit this sort of cataclysmic low in August, like the world's over. The dollar hit a high, the fear of trade was maxed out. And ever since then, we've had this slow narrative. The trade's going to get better. The U.S. and China will come to some conclusion. Next year's an election year, so there's a lot of incentive to do that. Dollar weakens, yields go up, economic growth resumes. That's the rally we're seeing right now.
Okay, let me move on because I want to talk about some other aspects of the ETF business that's got my attention. It has taken some time, but passively managed funds pegged to indexes have surpassed the assets of actively managed counterparts. This is according to Morningstar reports. Now we're talking about ETFs and mutual funds together. Passive funds have roughly $4.4 billion in assets by the end of September. And again, this is Morningstar. Actively managed funds slightly less, nearly $4.3 billion in September. Actively managed U.S. stock funds recorded their 8th straight month of outflows, and Morningstar notes that since March 2014, there's only been 2 months in which actively managed U.S. stock funds saw inflows. Okay, makes sense of this, Deborah. You're the expert. We've been talking about active versus passive for a long time. That trend is still continuing.
So I think the challenge is that people have learned that it's hard to find active funds that consistently deliver alpha. So if they do it 1 year, they're not likely to do it the next year or the following year. So on average, 7 out of 10 active funds do not beat the S&P 500 if they're a large cap active fund here in the US. And the same is true if you go around the world. I think the other thing that investors have learned is buying lower cost products deliver over a long run better returns for you. So if it's hard to find active funds that consistently deliver alpha, go to an index product like an ETF and get the benchmark and get alpha through asset allocation. So index does not mean passive. You're seeing people use ETFs to overweight countries, sectors, regions, and generating alpha through that. So they use a barbell approach to investing.
Right, so it's tactical, use of ETFs for tactical trading. That makes a lot of sense, but you're still using indexes by and large, though, even when you're using it tactically moving in and out. What do you think of the move towards ETFs that don't fully disclose their holdings? This is going to be a big movement. A lot of people are in active management now. They have a high cost structure, high fee structure. In mutual funds, they want to move to the ETF structure. My attitude is, that's great, but if you're a lousy stock picker doing it in a mutual fund wrapper, you're still going to be a lousy stock picker in an ETF wrapper. What's wrong with this story?
Well, so I do think the story is that by moving to the ETF wrapper, and that's a good point, an ETF is a wrapper, right? It's a mutual fund with the added benefits of being listed and traded on exchange, right? So you're right that many active funds don't deliver alpha. Moving to the ETF wrapper makes you more cost efficient because you save on some fund admin and transfer fees, and the in-kind creation redemption in ETFs makes them more tax efficient. So there's going to be some significant benefits from active being inside of the wrapper, but you're right, if you're not a good alpha generator as an active mutual fund, you're not necessarily going to be a good one as an ETF wrapper. So I think that is part of the challenge, and that's why when the first active ETF came to market with the ticker YYY, the resounding chorus was, why do we need active ETFs? Now, we do see that many asset managers feel they need to have an ETF strategy, and so many are deciding, where should I offer ETFs? Where does it make sense? And so they're jumping on the bandwagon.
So you know all about this. If you can't pick decent stocks and give good advice to your clients, it doesn't matter what the wrapper is.
Yeah, it does. It truly doesn't. I think you bring up a great point. It's about fees, and a lot of this stuff is about fees and how can you get the cheapest execution. And if you're going to have a bad stock pick, you might as well not pay on top of it a boatload of fees. But when you see this push into passive investing, it's about the fees, and it's about, people couldn't get into those funds before. Remember when you first started on the street? Yeah. You couldn't get into a lot of these hedge funds. Then everyone owned a hedge fund. And then, to your point, you only can beat the index for maybe 2 or 3 years. Then you underperform. Because you can't, because your longs and your shorts, your shorts always underperform. and the longs never outperform enough to counteract that.
Wasn't this Jack Bogle's central insight over at Vanguard? His central insight, he wasn't against active management. They had very good people. Wellington is still there at Vanguard, but his point was these guys have to charge so much that they destroy their alpha by charging that higher amount, and that's the problem. If you can do active management at a lower cost, then in some cases it's worth it. But even he noted the same thing Steve noted, they don't outperform for very long.
Yeah, look, the biggest issue is from when the mutual funds were growing from 1980 to 1999, the S&P compounded at 18% a year. Last 20 years, it's been 6%. So we've had a third of the return structurally that we had from the early 80s, and that's why you need passive management to not pay those high fees, because you can't afford it.
Bob, really quick, I'll put a bow on it. For my children, I have 4 children. I wind up doing all passive investing, all ETF investing for them, because if you're a stock picker, I could pick stocks, but I can't float the boat with my kids trying to pick a granular stock every day of the week. So I choose to buy 5 or 6 globally represented ETFs, and that's how I invest for my kids.
Good point. Let's move on here. It's not just passive investing. Inflows into ETFs in general continue to hit records, and it's not just in the U.S. Other parts of the world, Canada and Japan, for example, as well. Here in the U.S., assets under management, look at this, top $4 trillion. That's good news. There's more than 2,000 ETFs you can pick from, 136 ETF providers. Deborah, what's your assessment? We're talking about U.S. ETF market here. It's continuing to grow. I'm shocked that the inflows into bond funds still continuing at this point, but where do you see this heading?
I think we're still in the early days of adoption, because I think ETFs are now moving to a level playing field. With the ETF rule coming to market, it really means bringing ETFs out will be as easy as mutual funds. You don't have to apply for exemptive relief, which meant it took sometimes 681 days.
So you think there's going to be more ETFs? We got 2,000 already. Do you think there's going to be more coming?
Well, look how many active funds there are, right? So I think that you'll find that different types of products will come to market. I mean, we have hedge fund replication, and I mean, an interesting point is today the ETF industry globally is $2.5 trillion bigger than the hedge fund industry. And if you look at asset-weighted returns of hedge funds as an industry, for the past 8 years, they've underperformed the S&P. Now, you might not say that's the right proxy, but clearly you're paying a lot for those funds, and they're still not delivering alpha.
But Nick, you pay attention to these numbers. I see them in your excellent commentary every day. The top ETFs just keep getting bigger. Here's a stat from Deborah. I think you provided this. The top 10 ETFs in the U.S. are 28% of the ETF by market cap here. The top 20 are 40%. Wait a minute, we have 1,600 ETFs, no, 2,000 ETFs, excuse me, and 20 of them are 40% of the market. It seems like we got a lot of ETFs that don't have any assets at all, essentially, at this point. And does this make sense? I think it does make sense, because if you figure you move towards the index and you want a certain coverage of the index universe, you want mid-cap, small-cap, you don't need 300 choices.
No, it does make a lot of sense, because ultimately this is an industry that rewards economies of scale, economies of scope. And so if you're an ETF provider and you have a larger ETF, you can charge lower fees and put the product in front of more customers. So it makes a lot of sense that there's economies of scale and scope in this industry.
And go ahead.
Just remember, how many times have we done reports, and how many times have we all looked at each other in the face and said, there's only 6 stocks that matter? Yeah. So it's going to be the same thing with ETFs, that you're going to have only 28 ETFs that matter. So all of these encompass everything, but they mute the risk of buying a bad biotech stock that blows up and is down 40% the next day. You could mute that risk.
And Deborah, does it bother you with the same thing as with the ETF providers? We have 140 or something ETF providers out there, and 5 of them are 90% of the market. And essentially, iShares, which is BlackRock, here's the numbers up there, and Vanguard, and Spider, which is State Street, and Schwab and First Trust, added up, that's 90% of the market. And 5 out of 136 or 140 practically own the market. Does that matter at all, or is there any reason for us to care about that, or is this a sign those 5 are doing a darn good job?
I think it's a sign they're doing a good job, and it's economies of scale, as you just heard, right? So I think basically once you get large, there's a huge first mover advantage. And I also think there's a level of comfort with investors going to large firms, right? It's kind of covering your backside. You can't make an excuse for going with someone like that. So I do think we'll continue to see, look at the first ETF that was launched in the US that turns 27 next year, right? it's the largest ETF globally, the most actively traded. SPY is still used by people all over the world.
Before we go, I wanted to ask you about ESG, environmental, social, and governance. We've talked often about it, and it's become part of the conversation here at CNBC. The numbers are growing, but honestly, they're growing slowly. I see 18 billion in assets under management now. It was, what, 4 billion? There's the numbers, 4 billion a few years ago. This is still a small part of the business. Give us 20 seconds on where you see that going.
So I think it's becoming increasingly important, driven in Europe by the regulators, forcing it to be part of the discussion, and driven by people like your kids, right? They're going to have a view that they don't want to invest in companies that aren't doing things to help the climate or the state of the world going forward. So I think many people want to exclude certain types of stocks, and I think people want to reward those that are doing well. So I think ESG will no longer be discussed 5 years from now because the indices will be including those types of factors, and it'll be mainstream.
Still tough to get the metrics right, particularly on governance things, giving point values, but they're trying. It's a lot more scientific than it was 20 years ago.
Exactly.
We're not going to buy cigarette companies. You know, it's gotten an awful lot better.
And
20 seconds?
Look, all the big ESG funds, all the big five, they all own 4% energy. They all own ConocoPhillips.
Yeah.
So it's still a tough one to define.
Yeah, really tough. All right, thank you very much for coming. We really appreciate it. A lot of topics. I like hitting a lot of topics here. And that does it for this week's ETF Edge. I'm Bob Pisani. My thanks to Steve and Nick and Deborah for joining us today. Thank you for watching. You can find all of our latest videos right on our website, etfedge.cnbc.com. We'll see you next Monday, same time, same place. Have a good week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.